Good afternoon, everyone, and welcome to today's webinar on the autumn budget. I think it was quite a day yesterday. Just introducing myself, I'm Marie Pegram, and I'm one of the group managing partners at TC Group, and I'll be your host for today's session. I just want to say thank you, everyone, for joining. We've had quite a lot of interest on this webinar, and I know how busy everyone is at the moment in terms of Christmas coming up and things like that. So it's great to see so many of you signed up, and I think it shows us how important it is to quickly understand what yesterday's announcements actually mean in practice. So after weeks of speculation, I think probably the biggest build-up we've had for any kind of budget this year. And I thought to top it off as well, we had the OBR release the budget now before it actually was announced, which was quite interesting. But I've got to say, in terms of the sheer volume of complexity behind the detail, this is probably the most challenging budget I've ever seen. And I'm sure our panelists here will actually agree on that as well. There's a lot there. It's not easy to join up the dots. But the good news is that you're in safe hands today. I'm joined by a fantastic panel of experts from across TC Group who have spent the last 24 hours frantically going through all the detail and doing a great job in unpacking actually what it really means in practice for you personally and for your business. So our aim over the next hour is to cut through all the noise and focus on what really matters and come up with a couple of tax planning opportunities as well. Just a bit of housekeeping before we get going. We'll have a dedicated Q&A session at the end of the webinar. But please do feel free to submit your questions through the Q&A function in Zoom, and we'll pick up as many live questions as we can. But if we do run out of time, don't worry, we will get round to answering your questions after this webinar as well. This session is being recorded, so you can watch it again if you like. But everyone joining us live will get a copy of the recording and also links to our Autumn Budget Hub on our website as well. Just to say as well, we will be covering general information. We strongly recommend that you contact your TC advisor if you are a client, and we'll talk through your personal circumstances to make sure that we make the most of all the opportunities that are available to you. So I'd just like to introduce you to our panel. We've got Graham, who is a tax partner at TC East, and he'll talk through the key changes affecting individuals. We've got Elliot, who's a tax manager at TC Leeds, who'll talk through the main business tax changes. On the financial planning side, we have Jem, who's our independent financial advisor, who'll link the tax changes of pensions and investments. And looking at deals and succession planning, we've got Paula as well, who's an associate director in corporate finance at TC SEM. In terms of how our session will be run, we'll start with personal tax, we'll move into financial planning, and then we've got business tax and corporate finance as well. We'll then bring everything together, talk through some of the tax planning opportunities that are available, and also we'll finish with a live Q&A. So as I mentioned, just drop your questions into the Q&A function. Right, without further ado, I'm going to hand over to Graham, who's going to dive into the personal tax changes. Over to you, Graham.
Thank you, Marie. I don't know if you can drive it at your end. We've had a note that says, I think that the presentation needs to go into presentation mode. I think it's showing a funny setting. So we can maybe address that, please. Yeah, so I've got all the good news stories. Income tax thresholds frozen from about 2021 to 2028. That's been now extended to 2030, and we've got the range of rates up on the screen there. It's an incredibly effective way of collecting tax, the amount of money that brings in without having to change the rates. It's a really powerful fiscal tool. I think the range of tax brackets and what have you on the screen there, it shows it is getting a bit messy, has maybe got a bit messy. If those of you watching today who are owner managers of businesses or maybe got some control over your income, the ability to kind of time your income or limit your income within a given tax bracket, I think that just gets more and more important with these freezes. Can we have the next slide, please? We've also got these new income tax rates, and they're just really going to add a bit to the complexity, I think. So dividends going up in April 2026, property income and savings income a year later in April 2027. I think better news than one of the alternatives that was being bandied around, which was to have national insurance put on those types of income, but nonetheless sort of unwelcome to see those rates of tax increasing. Politically, it's sort of, sensible enough, I guess, from a practical point of view in terms of the tax legislation and how people understand tax. This is adding another layer of complexity. Some of those rates applying in Scotland, some of them not, for example, and lots of little things around the edges, like how are these going to affect income that's in a trust or in an estate or something that's joint or in partnership and so on. So lots of little oddities around the edge of this headline. I think we're going to see a lot more pages on the statute book. Can we have the next one, please?
Sorry, Graham, I'm just going to stop the share just for a second, just so we can get those slides sorted. Please bear with me just a minute.
Whilst we're waiting for that, Graham, actually, should we go through? I've got a question in terms of income tax rates thresholds
Yes.
what you're talking about. We can talk through that if that's got. Actually, it looks like the slides are back, so I'll hold fire and talk through that then.
Okay. Yeah, if we can have the next one, please. There we go. So lots of things that thankfully aren't changing alongside those rates of tax. So if you've got mortgage interest on a rental property, you're getting basic rate relief on that. That will now be the 22% relief on the mortgage interest. No changes to rent a room, property income allowance, dividend allowance, saving starting rate band, and so on. We are going to see a change in how you offset your personal allowance. So the government are kind of awake to the fact that people might choose to use the personal allowance against the higher rate income and let the lower rate income get taxed instead. So there's going to be some mandating of how you offset those tax-free allowances once these new rates come into force. Again, I think, nice enough idea, but it all just adds to complexity. With the next slide, please. So on inheritance tax, again, rates and tax-free allowances frozen for another year. These ones were already frozen to 2030. They're now 2031. That's going to be 21 years since the tax-free allowances increased. Really negative effect from a taxpayer perspective in terms of what that's doing to inheritance tax. There was no U-turn. I don't think we were realistically expecting a U-turn on the agricultural relief and business relief announcements from last year, but we have had a little softening. So where the £1 million allowances had originally been announced as non-transferable between married couples, civil partners, we were told yesterday those will now be transferable. So I think that's a sensible and welcome little change. It's a shame we didn't have it this time last year, and we've had kind of 13 months of planning on the basis that they wouldn't be transferable, but nonetheless a welcome change. Can we go to the next one, please? This was probably a big headline, pretty well leaked in the run-up to the speech as well. There's going to be a valuation conducted as at 2026, and that's going to be undertaken by the Valuation Office Agency. So these are some surveyors who are engaged by the government for various valuation tasks. Property is going to be banded according to that 2026 value. And I think once you're banded, you're in that band. And then the charge that applies to your band will be linked to CPI. So those are going to be index linked upwards from 2029 onwards. collected alongside council tax, and some mention of maybe some deferral mechanisms or things if you've got people who maybe have a very valuable house but not a lot of money, not a lot of income, maybe an ability to sort of roll those up, but you're not spared from the charge. It might just be some sort of mitigation to the cash flow pain of actually paying the charge on an annual basis. Next one, please. Electric vehicles, again, unwelcome. I don't think hugely surprising. I think we probably all knew that electric cars couldn't be tax favoured, road tax free, and sort of special treatment forever. We have got a couple more years, or just over a couple more years, before these rates come into force. And we do continue to have some reasonable incentives for companies buying these vehicles, which I know Elliot will touch on later. There's also a little softening of this expensive car supplement. So this is where you pay a sort of bumper rate of vehicle excise duty. I still get tempted to call that road fund license. For the first 4 or 5 years, that's going to be increased to £50,000 from next April, and for cars registered since April this year. So unwelcome, not altogether surprising, and for most people, 3p a mile over the course of a year isn't going to be a huge figure, albeit one you'd rather not pay. Next one, please. There were a handful of announcements on non-residents. I think this has been probably put on the radar somewhat by the non-dom changes that came in last year. I think there's quite a lot of talk about an exodus of non-doms and maybe people looking at moving overseas in light of some of those changes. And they were just a few little bits and pieces to tighten up the rules, make it just a little bit less attractive to be a non-resident with financial ties to the UK. So the dividend tax credit, for example, that's a sort of historic anomaly that needed cleaning up. The dividends for temporary non-residents, a sort of perception that was just a bit too generous and perhaps should be made a little bit less generous for people spending not at least 5 years outside the UK. The CGT loophole closures, very, very, very niche, very, very specific. They won't affect many people at all. Class 2, maybe a bit wider. So that was something Rachel Reeves spoke about quite broadly in her speech. This kind of paying national insurance whilst you're overseas and maybe getting access to the benefits that brings with it. That's going to be made much more limited, the circumstances in which you can do that from overseas. Yes, thank you. On capital gains tax, so a bit of focus on incorporation relief. This is a relief that applies when you take an unincorporated business and transfer it to a limited company. At the moment, that relief just applies as a matter of fact. From April, it's going to have to be claimed. And I think really the point here, there's quite a few property business incorporations that have taken advantage of this. There's been some news stories around the sort of Property 118 and some of the similar setups that were considered very aggressive and probably pretty flawed, that were relying on incorporation relief. So this measure just to sort of force taxpayers to put this on their tax return and really give HMRC the visibility that you think it applies, but they get the chance to check if they think it also applies. So it will increase visibility and make it a bit easier for HMRC to counteract that stuff. We've also had some changes in the share for share exchange rules. Now, these are quite commonly used in our client base, in owner managed businesses. This is where maybe a parent company is introduced or group structure is reorganized. Sometimes it's an exiting shareholder, some continuing shareholders. it was a kind of an immediate tightening of the anti-avoidance rule. There's what's called a motive test, and you can go off to the revenue and get advanced clearance that the revenue are happy that what you're doing isn't for tax avoidance reasons. They've just made that test a bit tighter. And I think it's just a byproduct of a couple of tribunal cases that they lost, that they didn't like losing. And so they've rewritten the rule book a little bit. That one's got immediate effect. So if you've got any kind of group reorganization or share transactions on the go currently, that one's definitely worth a review. And I think I've got one last slide. These were bits and pieces that didn't get any mention during the speech, but were tucked away in the red book somewhere. Consultations on accelerating tax collection, consultations on changing penalty regimes, and so on. I think the top one's really interesting. Looking at transactions between close companies. Now, those are unlisted private companies controlled by 5 or fewer people or groups of people. So really family businesses. Transactions between those close companies and their shareholders. We've already had the introduction of some requirements on the 2025-26 tax returns, where directors of those companies are going to have to say, yes, I'm a director of these companies, this is the registered number, this is how many shares I have, these are the dividends I received, etc. And the revenue obviously got their eye on this as an area they're interested in, maybe having some more visibility, and presumably with a view to having a lot more opportunity to challenge some of those transactions or to spot trends that they don't like. So I think these are just things that are coming next year, something to keep our eye on and update in due course. And I think that's the end of the private client section.
That's great. Thanks very much, Graham. I think with the income tax thresholds that have been frozen again and promised to be frozen again till 2030, that's like 10 years, I think, of fiscal drag that
yeah, it's huge. It's huge. When
Yeah.
you think about the cost of living and the sort of where the inflation's been through some of that period, the real term effect of it is astronomical. You look at the proportion of the population that are now high rate taxpayers compared to 10 or 20 years ago, it's so much higher a percentage. And that was what I was saying. It really is very effective as a way of collecting tax.
Yeah, it's massive. And I think in terms of the income tax thresholds, the rates and things, so I know that's going to be how they're applied, it's going to be slightly differently. So if, say, you had an income of 100k and 5k of savings and 30k of property income, what's going to happen? How's that taxed now, and how will that be taxed, say, after April next year?
So at the moment, you have your personal allowance, which is your tax-free amount, and you can allocate it wherever you like to get the best tax outcome. With these new rules, you're going to be required to allocate that personal allowance to essentially earned income first, so employed income and that type of income, and then only to apply it to property or savings or dividends income subsequently, so as not to be able to, sidestep the effect of that extra 2% tax.
Yeah, okay, so that's going to be another hit in the pocket then as well.
It is.
Okay, all right, thanks very much, Graham. So we're now going to hand over to Jem, who is going to be talking about pensions and ISAs.
Good afternoon, everyone. So Jem Turrell here in Christchurch in Dorset. Certainly much of the scary hype scattered across the media pre-budget for ISAs and pensions has not materialised, thankfully. For example, the removal of higher rate tax relief on contributions, or the reduction or removal of the tax-free cash lump sum allowance known as PCLS has not happened. But the use of salary sacrifice rules are changing, although not until April 2029. And the numbers certainly indicate that many numbers of people use this throughout their payroll. This will generate significant extra revenue for the Exchequer, and both employers and employees will need to rethink how they add funds to the pensions. But certainly continuing to add funds to pension is a prudent and sensible thing to do. That certainly hasn't changed. So just moving on to ISAs. Currently, UK citizens can add 20,000 per tax year to either a cash or stocks and shares ISA, or split equally between the two. The Chancellor has announced that these rules will be changing from April 2027, with the reduction of the amount that can be added to a cash ISA down to £12,000, other than if you're over 65. Now, it's worth noting that you are not actually forced to buy shares in a stocks and shares ISA. I certainly have clients who buy money market funds in their stocks and shares ISA. These funds behave like cash and pay interest. Personally, I think it better to view a stocks and shares ISA as an investment ISA. Shares are just one of the things that you can invest into. Personally, I hold a pure fixed income investment in my ISA that has no equity content whatsoever. And that's all for me at this stage.
Great, thanks very much, Jem. I think on the bottom of your slide around the pensions, you said 4.8 billion is going to be raised for that pension change. That's huge. I think that's
huge. That's why they're doing it. Yep.
Yeah, I'm quite interested to see how that's going to play out. But yeah, we've got a couple of questions that have come in for that, but I'll save that for the Q&A later on. So I'm now going to hand over to Elliot, who's going to talk about the business tax changes. Over to you, Elliot.
Yeah, thank you, Marie. Just a quick intro for those that don't know me. So my name's Elliot, and I am based in the Leeds office here at TC Group. So just before we run through some of the business tax changes, I just thought I'd give my comments on the budget as a whole. So I think the first thing I would say is that it's a lot better than it could have been. So it was inevitable that it would be bleak for some people, but some of the changes that have come in aren't as bad as they could be. So do yourselves a favour and stay off of social media for now and pick up the phone to speak to your tax advisor, because in theory we should know what we're talking about. And it isn't as bad as it seems. So there is limited impact on businesses from a corporate tax perspective this time round, which I will come on to, but there's a much larger impact when you view all the changes as a whole. So I think businesses are going to be squeezed even further, which is a shame to see, but we are where we are, so we have to manage that. As Marie touched on earlier as well, I think fiscal drag, which is this week's buzzword or buzz term, is the main driver of additional revenue. So I think they estimate about £8 billion is going to come from the freezing of the income tax thresholds, which pushes about 18% of earners into the higher rate bracket, which last time when Labour were in power back in 2010, that was at 9%. 9% of taxpayers. So we've doubled the number of higher earners at the moment. So it's effectively a stealth tax on income. Most people won't notice it because they won't be aware of it. So it's a bit sneaky really from the government, but it also means that the revenue is backloaded, so it won't come in until 2030. So it's a bit of a strange budget. There's no immediate cash injection. Or there is, but there's no great immediate cash injection. So that said, anyway, we'll run through this first slide. So capital allowances. The writing down allowance and main pool assets is now reduced by about 4%. No, sorry, by 4% exactly. So what that means is an asset that previously would have gone into the pool costing £10,000 would have been written off over a number of years. I think it works out to be about 12 years. Now, with the reduction in writing down allowances, we're going to see that written off and full relief gained over 16 years. So we're just slowing down the rate that we're getting this relief. So again, it's a reduction in the relief due to corporates at the moment, and unincorporated businesses as well for that matter. £1 million annual investment allowance limit still remains, as does the full expensing regime. So if you're not familiar with full expensing regime, it's effectively 100% relief on new but not second-hand assets which are not used for leasing. And what that meant is that there's still a gap in the leasing sector where there wasn't immediate 100% relief available for assets acquired by those businesses. Now, we've now got a 40% first year allowance. So it's not quite as lucrative as 100%, but it is an additional relief. So leased assets are now eligible for a 40% reduction in year one. So who will that impact? Well, primarily the leasing industry. So what we'd hopefully see there is a bit of a boost of investment in that sector. The slowdown in writing down allowance is probably going to affect those with larger pool balances. So think if you've got hybrid sort of company car fleets as opposed to EVs, which would have got first year allowances, you're going to then see a slowdown in the reduction of writing down allowances that you're about to get. And just touching on EVs, as Graham sort of mentioned earlier, first year allowances have been extended by another year. So for brand new electric vehicles, you can write off 100% of the cost of those assets, as well as the charge points that come with them, if you are installing those. EV excise duty, again, just to touch on this, so it will immediately just come off the bottom line when that comes in 2028. I've worked it out, it's about 20 quid a month for those that are doing 8,000 miles. Give or take a few pounds here and there. It's going to rise with CPI when it comes in, so it'll be an increasing burden, as you'd probably expect. But the big question mark here is how will that work from a mechanics point of view? I think the thought is that it would come in through sort of MOT tests or a mini MOT for brand new vehicles, but we are yet to see that. But the skeptic in me, and I suppose because I'm northern and I'm inherently tight, is that there's probably going to be a bit of an uptake in the dodgy MOT blokes who fit mileage blockers. Now, I'm not sort of condoning that, but I think the reality is there's probably going to be a bit of fraud around that. So it'll be interesting to see how they actually implement that change. So if we just move on to the next slide, just regarding national minimum wage. So there's been about a 4 to 9% increase depending on the age of your employees. That does say 12 plus, it should say 21, unless you've got a highly paid pre-teen, which fair play to them if they're on £12.70 an hour at that age. Anyway, my rough calculations this morning came out at about £700 to £1,300 per annum net cost to a business based on somebody doing a 40-hour working week. Now, that accounts for the corporation tax relief that you would get on the salary, but it doesn't factor in national insurance contribution. So it's not an exact number. It's just purely for illustration. So if you work on the basis about £1,000 for your minimum wage workers per year, if they're full time, so it's quite a big cost that somebody's going to have to pay for somewhere. So what that will do is drive inflation up even further. And for those that don't have minimum wage workers who think that they won't be impacted, you probably will, because your higher earners will expect an increase to avoid the erosion of their wages. So, you know, the gap between skilled and, for want of a better term, unskilled workers has now narrowed, and people want to be remunerated slightly more lucratively because of that. So businesses will trim down the workforce, there'll be a reduction in staff, and probably therefore a reduction in the quality of service. So if you've had the displeasure of contacting a broadband or utility provider recently, that will likely get more painful as the number of people in call centres reduces and so on. So what we're basically doing is we're getting less, but we're paying more for it. And I think that will hit everywhere in the country. So it was a shame to see, but I suppose some people are struggling to make ends meet. So it's a difficult position there for the government, and they've decided to raise the minimum wage again. So the other thing I just want to touch on is, just on top of this, there is the Employment Rights Bill, which is making its way through Parliament at the minute, which will ultimately give employment rights to staff on day one, such as your unfair dismissal rights, etc., etc. What that means is that it's just going to be tougher all around for employers from a cost mitigating aspect and from a HR position. So again, smaller businesses with smaller HR teams might start to struggle and feel the impact on that. So it's not looking great from that point of view, but if we try and stay positive anyway, we'll move on to the next slide, which is business rates. It's apprenticeships. So just quickly on here, because I'm running out of time, so that there's £725 million allocated to the growth and skills levy. Apprenticeships for those aged 25 or under in non-levy paying employers will now be fully funded. So what we'll see is the changes will effectively reduce what employers have to spend and the time that they have to spend it. In addition to that, the additional 10% added to levy contributions is also being abolished. There are other wider changes which will impact companies of varying sizes differently, which I won't go into because it's quite in depth. But I think considering the jump in national insurance, minimum wage increases, as well as the changes on apprenticeships announced yesterday, we're probably going to see a reduction in training rather than increase, which is a bit disappointing, especially for the younger generation. So it'll be interesting to see how how businesses work around that. The next page, we've got EMI schemes. So for those that aren't familiar with EMI schemes, they are ultimately a very tax efficient way of incentivizing key members of staff by rewarding them with equity in the business. Changes were announced yesterday, which ultimately double or quadruple the size thresholds for the businesses that are able to participate, which is a good thing, because what that means is a lot of larger corporates can now participate in EMI schemes. So what we'll probably see is a lot more share options being granted to staff for much larger businesses, or I would hope so anyway. And in conjunction with that, the time limit for losing the reliefs has been extended from 10 years to 15 years. So what we're going to probably see is longer term planning coming into play here, which can only really be a good thing. I think EMI schemes are probably going to become more and more popular because we've got no income tax breaks, salary sacrifice is being attacked, the minimum wage is narrowing the gap between certain employees, and so that's going to leave the door open to discuss EMI schemes. And I think it will be a good thing. We'll probably regret saying that because we'll be a lot more busy dealing with them. But for those that aren't familiar with it, I would certainly suggest speaking to your tax advisor to see if you're eligible and if it would be worthwhile for key members of staff. There are similar increases to limits for EIS schemes and VCTs, but I won't discuss that now because it's more of an income tax point, I suppose. If we could just go on to the next slide, please. Now we've got business rates for those that are waiting. So business rates are payable based on the rateable value of a property, and then a multiplier is used to calculate what is payable on that rateable value. Now, the rateable value will be based on April 2024 values going forward instead of 21. And in particular, the biggest change that we're going to see here is from the 1st of April 2026. The retail, leisure and hospitality sector will see the current 40% relief replaced by a permanent 5% reduction in the multiplier. I think we've had a question regarding this, so I won't discuss that further at this moment, but we'll come on to that. And otherwise, what we'll see is a high rate placed on properties with a rateable value of over £500,000. So I think that, in conjunction with the mansion tax that we'll see from a council tax perspective, will probably make property teams, especially here at TC Group, pretty busy. So again, speak to your advisors if that is an area of concern. And then just quickly from me, because I have overrun here, but some miscellaneous updates. We've got R&D. We have an advance assurance service coming in from Spring. Now, I thought that was coming in before yesterday anyway, so I'm not entirely sure if that is a totally new announcement or if it's just clarification. But anyway, it should give a bit more clarity regarding R&D claims for certain firms, though it's yet to be seen how quickly HMRC respond to those, because they are notoriously slow in the R&D department. Corporation tax penalties have doubled, so it's now doubly important to get your returns in on time. And then aside from that, there's been some changes to the corporate interest restriction, mostly around admin and nominating reporting companies, which now has to be done annually. And there's a common sense approach taken to those that fail to do it on time. And there are some changes in relation to the calculation of the CIR, which I think is only forecast to impact 50 companies in the country. So no point discussing that here, but that's all from me. Lot to say, but there's not really that much there from a corporate tax perspective. It's more on the commercial aspect, I think, that we're going to see businesses impacted here.
That's brilliant. Thank you very much, Elliot. I think the EMI scheme change is going to be quite interesting to see. It's quite nice to have that opening up to more businesses. There is sort of a silver lining in some of the announcements that have come through. So I'm now going to hand over to Paula, who's going to talk through some corporate finance areas.
Okay, thank you, Marie. Hi, everyone. Can you hear me okay?
Yes.
Oh, perfect. Okay. And so I'm going to talk about just a whistle-stop tour of the key considerations that business owners just need to think about when they're considering succession and their exit strategies. But firstly, just to say, Elliot, I completely agree with you. This budget is not as bad as it could have been. And actually, it's really important for clients to speak to their TC Group advisor to understand the collective impact that this budget will have on their business and on them. So firstly, we can see on this slide capital gains tax and business asset disposal relief rates. So there is good news. The good news is that there's no further changes at the moment. So these were changes that were announced in last year's budget. So they remain in place. So we've known about this impact for a year. So there's been time to plan and work within these within the timings. For sellers who are in the process of selling to a third party or to a management team, and if you didn't manage to achieve a completion date by this budget date, what this means is actually there aren't any additional increases in tax that are going to negatively impact you. So that is unlike last year. So last year we saw overnight an additional 4% in the capital gains tax rates impacting sellers if they didn't manage to complete a transaction by the last autumn date. But now what we know is that actually, if you're in a transaction, all eyes should be on trying to get this completed by the end of this tax year, which is fine. We've known about that for a year. However, we do need to go on to EOT. So this is the next slide. So selling to an employee ownership trust has once again been a focus, or one of the focuses of the autumn statement. So employee ownership trust, it's a form of ownership that was set up in 2014 to encourage business owners to sell to a trust for the benefit of all employees. And it was to drive growth and productivity in the economy. What owners benefited from full relief against capital gains tax at that time. But what we saw announced yesterday, that immediately that relief has been halved for business owners. The rationale that was quoted yesterday was that the relief has cost the Treasury significantly more than originally anticipated. So for owners now who are going down or in a process of selling to an employee ownership trust, this immediately impacts them if they didn't manage to complete a transaction by Wednesday. But that said, I think it's really important to make this point that this is still a highly tax advantageous for business owners. So we're looking at an effective rate of around 12% versus 24% if you're selling to, say, a third party or to a management team. So still very, very generous. But what I think this will prompt for business owners is when you're thinking about selling, is fully considering all the options available to you in terms of succession and exit, to fully explore the pros and cons before making that decision. And that is something that our corporate finance teams work regularly with business owners to work through and understand.
Thanks very much, Paula. I was just going to say, with the EOT, I don't really understand why they've made it so complicated in terms of 50% qualifies. Why don't they just tax it at 12% of the whole gain rather than, but anyway, it's interesting. We're now going to talk through on some tax planning opportunities. Just to be clear, the information that we're going to be providing is for general guidance only, and we recommend that you obviously take professional advice on your own personal circumstances. So I'm going to hand over to Graham, who's going to kick off about profit extraction.
Yeah, thanks, Marie. So to do with these increased tax rates, the dividend rate's going to be changed next April, so just 4 months or so away. We had a kind of hike in dividend tax maybe 8-10 years ago, and there was a real rush by owner managers in particular to pay some dividends out ahead of the change. So some definite question marks as to whether we're going to see the same again. If we're seeing companies that have got plenty of reserves, plenty of cash, whether they're going to look to get a dividend in under the current rates. I don't think the government are going to have any great objections to people doing this, because ultimately it accelerates tax collection. So the government are happy because they get the money quicker. The taxpayer gets the money 2% cheaper than if they wait. That's not a huge reward, 2%, but if you're thinking about taking some serious money out of the company, might be worth having a look at that.
Well, just to follow up on Graham's point regarding profit extraction. So, what I was hoping to do here was stick a graph, a visual, just to aid this explanation, but I wasn't quick enough at pulling it together, so you'll have to bear with. So, what we are expecting now is for higher earners. So, at the minute, that means those, or in this regard, sorry, that means those that earn around or over the £300,000 mark. Where previously you'd have a salary versus dividend or a mix of salary and dividends as a remuneration strategy. What you are most likely to find now is that once you tip over that 300 grand mark, you're probably better off just taking everything out as salary because of the recent increase in dividend tax. So it used to be about 500,000, I think, that limit. It obviously depends on various issues like pension contributions and bits like that. But as a general sum, if you're a high earner, don't just take it as we have for the last sort of 10 years that dividends would be more lucrative. Make sure that we are planning remuneration strategies out with your tax advisors at TC. So the other point on this, regarding the £20,000% marginal rate, it hasn't really changed since yesterday, but I think it was worth mentioning because I think people aren't really aware of it. And whilst it does impact a small percentage of people, it just sort of exaggerates the urgency that people should be looking at the remuneration strategies. So if you have children and claim child benefit, and you also benefit from free childcare, and you earn £99,000, then the next £1,000 of your income could have a marginal rate of about 20,000%. And what that means is that your net take home pay will fall by about 20 grand. And what that means is that you will lose your tax-free, your free childcare, because you'll tip over the £100,000 threshold limit. Now, it's relatively easy to monitor that and to work around it. You can just stick some money into a SIP, for example. But the point stands that there are probably some people out there that do have an incredibly high marginal rate of tax because they aren't planning. And just if you do have children, you are around that sort of £90,000 to £100,000 marker, and you do benefit from free childcare, make sure that you have this conversation with somebody at TC so we can advise you accordingly.
Over to Jen now.
Hello again. Changes announced in the budget increases the importance and necessity of good tax wrapper management. Now, I'm guessing some of the folk on this call may not be familiar with the term. So a tax wrapper is essentially a legal structure or financial account that surrounds a financial asset, providing specific tax benefits. So a bank deposit account is a tax wrapper, as is an ISA, a pension, an investment bond, a VCT, and others. Tax wrapper management is the process of strategically using different efficient accounts or wrappers to hold financial assets, with the goal of minimizing tax liabilities such as income tax, capital gains tax, and inheritance tax, and maximizing overall after-tax investment returns. There are over 1,000 tax relief or allowances in the UK system, and the management element is about using these proactively and aligning them to your long-term goals, retirement plans, and inheritance tax considerations. The complexity of the UK tax system means that there isn't a one-fits-all mechanism, and I would stress the importance of seeking professional advice, as many of my colleagues have said today. But some of the key aspects of tax management, tax wrapper management, are understanding and using your allowances. The core of management is about making full use of annual tax-free allowances for various wrappers, such as the ISA allowance of £20,000 per tax year and the pension allowance of up to £60,000 per year. Strategic asset allocation. Different assets, investment assets, are better suited to different wrappers. For example, fixed income investments that generate high levels of interest are often better suited to ISAs or pensions where gains are tax-free. Timing and withdrawals. Management also involves planning when to access funds. For pensions, 25% can typically be withdrawn tax-free, with the rest subject to income tax later in life. ISAs, on the other hand, are free of tax when income or capital is withdrawn. Another example is investment bonds, which allow for tax deferral, giving better control over when a tax liability is realised. So to summarise tax wrappers, the benefits are minimising your tax liability. In my experience, too many people in the UK pay more tax than they need to. I'll just repeat that. Too many people in the UK pay more tax than they need to. Minimising after-tax returns. By reducing the tax drag on investment returns, more money is retained and growth can be greater over time. And strategic tax deferral, altering when taxes are paid, can mean that lower rates of tax can be levied. Just move on to the next slide, please. Gift and spend, baby. So some of you may be wondering what this headline is referring to. The combined total wealth of UK citizens is estimated to be somewhere between 12 and 13 trillion pounds. So a billion is 1,000 million and a trillion is a million million. I'm sure it won't surprise you to learn that most of this wealth is held in property and pensions. Equally, it won't surprise you to learn that the over 65s own a disproportionate level of this wealth, with some research indicating that this could be as high as 80%. This means that the UK is currently undergoing the greatest intergenerational wealth transfer ever seen. So it shouldn't be a surprise that the basic IHT nil rate band of 325,000 set in 2009, as Graham mentioned, has been frozen again to April 2031. Pension assets are currently exempt from inheritance tax, but as we found out at the last budget, this is changing from April 2027. Now, most of us spend our working lives accumulating wealth to fund the latter stages of our lives. Many people are also rightly concerned about the uncertainty of the cost of care towards the end of their lives. The reality of this means that the size of estates subject to IHT is getting larger. Now, good financial planning involves undertaking something called cash flow modelling. This is a planning tool that uses software to project your future income, expenses, assets, and liabilities over time. It helps you visualize your financial future, test differing scenarios, and make informed decisions to achieve long-term goals like a comfortable retirement, and importantly, whether you have more wealth than you'll need in your lifetime. Certainly in my experience, many people do have more wealth than they actually need to fund their lifestyles. Enjoying your wealth by increased spending or gifting it away is a key component element of inheritance tax planning. The pre-budget concerns that gifting exemptions and rules would be altered haven't materialised. Good tax wrapper management includes thinking intergenerationally, and contributing to your children and grandchildren's ISAs and pensions is exceptionally prudent. There are no changes to the budget to junior ISA allowances or the ability to start building a pension pot for children. Certainly more and more people are beginning to do this. I'm one of them. My grandchildren benefit from my wealth. Tax wrapper management can be a complex process, so I stress again that seeking professional advice is always sensible. So speak to your TC tax advisor or financial planner.
Great, thanks very much, Jem. We've got Graham's going to talk about inheritance tax.
Yes. We've got the transferability of the £1 million agricultural relief, business relief caps, which I mentioned earlier. That's a welcome change. Those rules come into force in April 26. We've had the draft legislation since 21st of July, so we've got reasonable clarity on what we think those rules are going to look like, and there continues to be a kind of window of opportunity especially around trusts, if you're thinking that a trust might be a suitable vehicle for succession of either your business or your farm, as the case may be, that clock is ticking a little bit. It's until April we've got this chance to get relatively unlimited amounts of APR or BPR assets into a trust. Once we get to April, that's expired, and we start seeing tax charges on transfer of those assets. So we've talked about this back in September on a dedicated webinar. We spoke about it at the last budget, but just to reiterate that point, that there is a bit of an opportunity. It is somewhat time limited, and it's something to get on with if you are thinking about it.
Great, thanks very much, Graham. So we're now going to move on to our Q&A section. We've got quite a few questions that have come in, so I'll try and whistle through them as quickly as I can. But as I said, if we don't get to your question, don't worry, we will respond after this webinar. I'm also probably going to jump around a lot because there's lots of different topics that are being covered in this Q&A, the questions that are coming in. So I'm going to start off with, and direct this at Elliot. This is a question that we received actually before the webinar went live. Could you please clarify if the 40% retail and hospitality discount has been scrapped on business rates, please?
Yes, I've had a few people ask me that already, and the answer is it has. So the 40% has now been totally replaced, and what that means is that the effective relief for the leisure, retail, and hospitality sector has gone from 40 to 10.4%. So you basically quartered the relief that these businesses were getting. So it's likely to have an impact on the high street and pubs, which is sad to see. But again, we are where we are, and that's what we've been given, I'm afraid.
Okay, thanks, Elliot. We've got a couple of questions around the salary sacrifice pension changes. So I'll direct these to Jem, but I think Graham, you might need to jump in as well. So I think is there any potential planning opportunities that businesses can do to avoid the change by restructuring contracts or altering the type of pension fund that their payments are made into? Is there anything they should be considering in offering staff as well? So, Jem, I don't know whether you're able to answer those questions.
I think it's why there's such a long lead-in time to when this is actually going to be enacted, to allow businesses to adjust and give thought to what actions may be taken. It's probably a bit early to say what those might be, but I think the ability to look at the contribution level, certainly there's a requirement by law as to what needs to be paid into pensions, and that can be changed. And is it a question of reducing people's salaries and increasing the employer's contribution? That's certainly going to be something going to be looked at. Difficult to say precisely what we might be able to do at this stage, but certainly I for one will be looking at this very closely, that's for sure.
Yeah, I'd just add to that. The wording that's been used in the publications is quite careful, and it definitely is focused on salary sacrifice. There is mention in places of employer, I think, normal or ordinary employer contributions continuing to enjoy NI relief. So I think, yeah, as Jem said, we've got a long lead time, and that might become a bit clearer as we go. But there might be quite a stark difference between a salary sacrificed contribution and a contribution that's just modelled on your contractual terms with your employer. And I think that will be something that needs looking at very carefully. I think the counterbalance to that, we had on the slide how much tax the government think this is going to raise, 4.8 billion in the first year. They are not going to very easily let people sidestep this. If they think there's some mischief, they're going to have their eye quite closely on that, I think.
I was quite shocked when I saw that amount.
Probably true that we'll get further clarification in future budgets as well on this topic. So yeah, definitely watch this space. But yeah, that number's a big number, that's for sure.
Yeah, thanks very much, Jim and Graham. So I've got some questions on the on EOTs. So direct these at Paula. We've got one that's saying if an application has already been HMRC approved but not completed, can they still claim under the old rules with the 100% CGT relief?
Okay, that's a good question. I think the government stopped, or HMRC stopped providing tax clearance following the last budget in October 24. So these rules will effectively look at when legal completion has taken place. So if legal completion of sale to an EOT hasn't taken place, then these new rules will apply, and that tax clearance effectively is not valid.
Okay, thanks, Paula. And also, in terms of with EOTs, if you've already transitioned to an EOT, and you've got deferred payments, were they taxed?
So that's fine. That would be taxed under the old rules.
Great. Okay.
Because if that legal completion has taken place pre-this budget, that's fine. This is about anything now happening from Wednesday going forward.
Brilliant. Thanks very much, Paula. We've had a few questions around the slides. Yes, the slides will be available after this. They'll be shared out along with the recording of this webinar. We've also had questions around EMI schemes. So I'm going to direct these at Elliot. So in terms of the 10-year now extended to 15-year, does that apply to existing EMI schemes, or is that for all future ones?
So that is a very good question. So what we've been given so far, it starts off by saying it is for eligible contracts which are granted from the 6th of April 2026 onwards. But there is also sort of a follow-up to that says it can apply retrospectively to existing contracts which haven't yet been exercised or lapsed. And it does mention that you can amend the arrangements without losing the tax reliefs, providing that all the other conditions are still met. So what I imagine that means is that those who have been granted with options over 10 years, you could potentially amend the option agreement to extend that to 15 years. But the legislation hasn't yet come out, so this is purely on the guidance. But it looks like they're gonna extend it as long as you haven't already exercised.
Okay, thanks, Elliot. We've also got a question around the dividends and tax rates. So I'll direct this at Graham. So with the increases in tax rates and dividends, bearing in mind corporation tax 25%, the traditional profit extraction models, I think we've kind of covered this already, but for directors and shareholders, are they going to go and change from dividends to salary, basically?
I don't think there's going to be a huge knee jerk in that direction. I think, as Elliot said, there are going to be some levels where it makes sense to be paying a salary. Certainly the gap will have been narrowed. So the motivation to use a dividend will be less significant than it perhaps used to be. The government paperwork, they tried to put some infographics in, and they sort of showed the corporation tax plus dividend tax rate compared to a PAYE, and it was pretty close, but it was still just a shade under. But yeah, it's narrowed the gap. I don't think it's a kind of landslide one direction or the other.
Okay, thanks, Graham. I'm conscious of time. We do have a quick poll that we're going to be putting up shortly. And this is just to find out if you need any more information or any more support. So I think that's due to go live. There we go. So if you wouldn't mind just spending 5 minutes, 5 minutes, probably 30 seconds just answering this poll. And then we're actually going to wrap up this webinar now. So what I'd like to say is just a massive thank you to you all for joining us on this afternoon. Hopefully we've covered quite a lot of questions and you've got a bit more detail about all the changes that happened recently. I would want to say a huge thank you to our panelists for their time and insight today. So thank you, Graham, Elliot, Jem and Paula. I know you've all worked quite hard over the past 24 hours trying to unpick all the detail and things that were shared yesterday. Just as a reminder, the information we cover today is general guidance, so we really recommend that you pick up the phone and talk to your TC advisor and get some advice. We will be following up with an email shortly, so that will have a link to the webinar. You'll have access to our Autumn Budget Hub as well, and contact details of the speakers that you spoke to today. And we will also respond to all the questions as well that come up that we didn't have time to do. But I'd just like to say, on behalf of us at TC Group, thank you very much again for your time and enjoy the rest of your day.